Governments are rushing to reassure citizens that their money is safe after the US saw its biggest banking collapse since the global financial crisis. Silicon Valley Bank's demise was closely followed by that of New York-based Signature Bank. The US insists a repeat of 2008 is not on the cards. But how contagious could the problems be?
After the collapse of Silicon Valley Bank on Friday and the sudden shutdown of New York's Signature Bank over the weekend, US regulators are taking extraordinary measures to avoid the spread of a larger banking crisis. The Biden administration said that starting Monday, all clients will be able to access their money and that all deposits will eventually be protected, including the uninsured ones above $250,000. On Sunday, Treasury Secretary Yellen said that the measures are not a bailout like that of 2008.
Well, let me be clear that during the financial crisis, there were investors and owners of systemic large banks that were bailed out, and we're certainly not looking, and the reforms that have been put in place means that we're not going to do that again, but we are concerned about depositors and are focused on trying to meet their needs.
According to U.S. officials, the rescue operation will be funded through federal banking insurance reserves and not taxpayer money. While U.S. regulators had to trigger the special measures after failing to find a buyer for Silicon Valley Bank, the British government was able to facilitate a private sale of the bank's UK arm to HSBC Holdings for the symbolic price of £1.
Well, let's discuss developments at SVP and the implications worldwide with Moritz Schulerich. He's Professor of Economics at Sciences Po in Paris and the University of Bonn. Thank you very much for joining us on the programme. Let's get straight into that issue of contagion. Is there a danger of the US banking sector beyond SVP and Signature Bank falling into a similar situation?
Yeah, thanks for having me. So, I mean, much less than last night in terms of contagion risk, because the US government really has taken quite decisive action. The US is I would say traditionally good at crisis fighting, at financial crisis fighting. So they've really put something together over the weekend that should reassure depositors in these two banks. This being said, these things are inherently difficult to forecast. And the truth is the problems that brought down Silicon Valley Bank and Signature Bank are not limited to these two banks. So the question is, who else is out there? And I bet you many market participants are trying to find out right now who the next candidates are in line.
So the conditions that you're talking about, are we talking about their exposure to the tech sector and in case of Signature to cryptocurrencies, and are other big banks? No. It's much simpler than this. No, it's much simpler than this. There's no. I mean, the tech angle is secondary. What has happened is that interest rates have risen, as we all know, quite significantly over the past year or so, and these two financial institutions had invested in bonds and long-term interest rate products that have lost significantly in value because, they bought them for as an interest maybe of 1 or 2% a year ago, and now the yield on these is 5-6%. It means that the price has gone down substantially, and that's not a problem. They get their money back in 10 years or 20 years, depending on what kind of asset it is. But if they have to sell these assets in the meantime, they book a big loss. And since they had depositors who were not willing to wait and were withdrawing their money, they were forced to sell these assets at a loss. And eventually they had more losses than they had capital. So they were out of business. And that big problem that, you can look everywhere in the world, that banks and financial institutions have made loans at, a year or two ago, think about a mortgage rate in Germany at 1% or below, and today these long-term rates are at 4%, and so there are financial institutions sitting on considerable substantial losses. Yeah, we have heard from the governments in the UK and in France, and also the regulator in Germany, trying to just reassure people that their systems are resilient to the sort of thing that has been happening in the United States. Are they just saying that to prevent a run on the banks, or is that justified?
No, I think you have to look very closely, and Silicon Valley Bank and Signature Bank were special cases where indeed these losses met a funding structure of these banks, i.e. a way of these banks were effectively refinancing themselves that was very prone to being unstable and for the bank run situation to develop. That is not the case with your German Sparkasse or others. But the general phenomenon that with this rapid and very, very large, big change in interest rates over a short period, there is interest rate risk out there, as people say, like you lose money when rates rise. And somewhere in the financial system, these losses are, and investors and market participants are now scrambling to find out who else is affected by that. So my best guess for the coming weeks is that we will still be in a very sort of unstable, wobbly environment where it's not clear if there's anyone else out there who has made similar mistakes, similar to what Silicon Valley Bank and Signature Bank have done. Remember, not so long, half a year ago, we had the same issue in the UK pension system. So it's always the same phenomenon where financial institutions are borrowing funds in the market at short maturities. They have invested in long-term assets, and these assets have lost in value.
But there will be more rates decisions in the coming weeks. If it's going to be wobbly for a few more weeks yet, when the Fed meets to decide on its next rates hike, will it be taking into account the situation with the banking sector when it decides whether to hike them by 0.25 or 0.5 this time round?
Absolutely. I think the events of the past few days will play a role in central banks' decisions to come. There was sort of an unofficial, if you will, motto for what's going on is like central banks are hiking rates until something breaks. Now something has broken. And it will certainly mean that interest rate increases from here on will come with this caveat of what does it do to financial stability. I think we've just found out there are risks out there, and central banks will have to be quite cautious and be aware of these potential risks in the financial sector.
Yeah, something's been set in motion over the past few days, hasn't it? Well, Professor Moritz Schullerich from Sciences Po Paris, thank you very much for joining us on TW Business.
Thank you for having me.